Are silver and gold buyers bracing for a crash? Hey, I'm the Stacking Stormtrooper. If you're new to the channel, I'm not a financial advisor. I'm a guy in a bucket talking about precious metals. So make sure you hit the subscribe button, get the bell notification clicked, and that way you get updated with any new content. In today's video, I am going to be commenting on a recent interview on KITCO, where they are discussing the fact that silver and gold buyers are bracing for a crash, not only just in the stock market, but for the precious metals market as well. I do think that this interview is very important and is going to be a wake-up call for many precious metals investors.
Our next guest is preparing for a big crash coming up in the markets, and he is fully allocated into defensive assets. Here's why, says Clem Chambers of Investors Hub. Clem, welcome back to the show. It's a pleasure to speak with you today.
Great to be back. Well, I got a warning from the market about 10 days ago, and I went, we're going to crash. So I've cleared the decks because I think it's highly likely, not absolutely certain, but too likely to be in the markets that we're going to be in for a crash. And I think a lot of people have had a pretty rough ride over the last few days. And, you know, normally before a crash, I experience what I call a market malfunction, when my portfolio just doesn't behave as it should, or as it has been behaving. And I thought, well, there's something wrong here.
Behave yourself, portfolio.
And I looked at things and I thought, well, you know, I couldn't forgive myself if I was in the market and it crashed right now, because all the American charts are saying trouble ahead. So I just cleared the decks because I think coming up to the election, we're going to get a crash. And you know, I would say 65 to 70% sure of that. And a crash is just not something you want to be in the market for unless you are really a dyed-in-the-wool buy and hold sort of person. So I'm out. I mean, I can't bear the way the market is at the moment. I've got 3 positions left out of, say, maybe 30 or 40. And until this crashes out of the way, or until the market convinces me that it's not going to crash, I'm out. I'm going to have to just sit on my money and stare at the action and stand to one side. And I'm not always right, but I've caught all the crashes since can't remember now, since 2007. And it's always good not to be around when they happen. And you can always buy afterwards and see what happens.
All right. So basically, he is saying that if you are holding stocks right now, it's probably a good time to dump them. I just actually bought a whole bunch of stock not too long ago. And so I'm actually on the fence myself, whether I'm going to keep or if I'm going to sell them, because he is saying that he's pretty sure that there's going to be a crash. I just did an interview the other day with Christopher Mullen. He's also of the mindset that there is going to be a crash very, very soon. So this actually might be a very good time to be stacking fiat, which a lot of people within the stacking community, they think that it's absolutely the worst thing on earth. But this might be one of those times where you actually should be stacking a little bit more in cash than in precious metals and or investing in stocks.
Clem, when you're talking about a crash, how big of a magnitude are we talking about?
Well, the times are so extreme, it's very difficult to judge. But I mean, I call a crash 25%. And, you know, if it's a massive crash, it'll be 40. But somewhere between 25 and 40% are 9 times out of 10 the crashes that occur. And, you know, even if you look at the Wall Street crash, it crashed, but it recovered a long way. And then it basically slid off. And you could take that whole 82% fall as a crash. But really, the crash is the first part of things. And I think we're going to get a severe downdraft that will be 20 to 30% somewhere between now and the election, and maybe even a little bit after the election if it doesn't happen to that. Because, you know, the way that the market is set up, the drop is so steep. I mean, so many companies have a mind-boggling valuations.
And that's completely true. Oh, and I like how I paused that on that expression on his face. That's kind of funny. But yeah, right now we have been seeing a bull market for a very long time. I mean, it's been a positive trend for the last 10 years, give or take. So we definitely need a correction, and it's on the way. But what he's also saying is not only are the stocks going to probably take a hit, but investors are going to get spooked in other areas, and so they're going to probably panic sell in the precious metals as well, which we all know that that's actually going to be a prime buying opportunity for us. And I just want to comment again that he really looks in this shot here that he stubbed his toe. Or maybe he stepped on a Lego.
Mind-blowing valuations, and we know why.
Or banged his shin.
Why they're so high, because of all the money printing, and that money's got caught in the banking and financial system, and it's been pushed into lots of stocks and the glory stocks that we all know. Well, that is incredibly fragile, and now we're going to go through a fragile period up to the election where pretty much anything could happen, and none of it particularly good. So, I see that as, most of my positions are not in the US, but if the US goes, and I can't see it not going sometime in the next few months, then it's going to smash everything else. And, talk about liquidity trap. When it happens, there'll be so many margin calls that pretty much all assets are going to get smashed, just as they did in the crash earlier on in the year. Gold got smacked, crypto got smacked, they all got smacked, because when the market crashes, it's the people getting margin calls that causes the knock-on vicious circle.
Clem, 2 weeks ago, you wrote a report for Seeking Alpha, and you had written that you would recommend an allocation of 33% stocks, 33% crypto and gold, and 33% cash. Obviously, things have changed for you because you're no longer advocating for the allocation. What exactly triggered you to sell everything off?
Well, I would say if you didn't think there was going to be a crash, that's how you should allocate your money. And investing is always a personal choice. You might say, there's not going to be a crash. I want to be in the markets. And I think that's a very sensible allocation right now, because at some point, maybe not very soon, but at some point, all this money that's in the system is going to come out in prices. And that's the way to navigate between a situation which could be deflationary on the one hand and could be inflationary on the other. And you can go between those assets very cheaply, very quickly, and pivot between an inflationary or deflationary outlook, depending on how this crisis pans out. I personally, if I wasn't out of the market and sitting on my cash waiting for this crash to roll by, I would be a lot more in equities and in gold and crypto than I would be in cash. But you can't be in assets if you're going to get a crash, and a crash is normally a very short-term thing. So it's basically a blip. It's like a piano falling out the window. You just don't want to be under it. And, if it crashes, I will buy the bottom of that crash, or attempt to buy the bottom of that crash, and then revert back to normality when the market does. And in normality, I would definitely be navigating between inflation and the potentials of deflation by moving between those three poles. But I personally believe over the next 3 years, you'll see 100% inflation. So you'll see your money being devalued, cut in half. But I don't want my equities cut in half in the next 90 days. So, I'm in cash because I don't think there'll be an amazing explosion of inflation up to Christmas. I think, you won't see much in the way of inflation coming in the very short term, but over the medium and long term, you'll be seeing it in spades. So I will be, when this crashes out of the way, navigating towards that end.
Basically, and this is something that I have been thinking of myself, I do feel that there is going to be a crash just because we are long overdue. And I am right now, like I said, I do have some stock that I've just been kind of day trading on my own. That's aside from my 401k and my 403b. But I do intend on keeping my money within the stock market. I know that most likely when this crash occurs, what I currently have is going to definitely lose value. I mean, he's talking 25 to 40% of a crash with the current prices. And so what my plan is to basically try to wait until we kind of see that bottom. And once things start kind of coming back up, that is when I'll probably buy more into the positions that I currently have. And then that's going to basically dollar cost average me down. I don't want to be out of everything completely. Because, I've done that once before and I felt like it was a major mistake on my part. So what I have right now in the stock market, I know that it's going to bounce back up in time. I'm fairly young in all things considered, so I do plan on staying in stocks for the long term. So once that crash does occur, I will be buying more.
Glenn, we're going to talk about inflation in just a moment, but going back to this crash, usually when we see a large panic in the market, a fire sale, if you will, you're going to see a correlation of 1 across asset classes, meaning everything falls together. Can we see that happen today or at this time?
I'm almost certain of it, because there's a lot of things that I love that I've got out of, because there's no point in, being tied up in something that goes down by 30% and then have to wait 6 months for it to recover. So yes, I think that is absolutely what will happen if it crashes. Gold will get hit, crypto will get hit, everything will get hit.
All right. So again, all of you that are watching this video, you're in the stacking community. He is saying that when this crash happens, that we are going to not only see it in the stock market, but we're going to see it in precious metals too. And that again is what Chris Vermeulen, who's also a technical trader and an expert with precious metals, he did say that as well, that we're looking at a major pullback within the next 3, 6, even possibly 12 months, but it's heading our way. So if you are not currently stacking cash for this type of event, you probably should. Now, right now, though, too, we are seeing relatively good prices when it comes to silver and gold, all things considered, because we did see that, those spikes about a month or two ago. And so now we have been witnessing this pullback, and it's been a good buying opportunity. But he's saying that they're expecting a precious metals pullback as well, and it's going to be due to a panic sell-off from a lot of people who are spooked in the market. So it's going to be a good opportunity for those of us that are in this stock, in the stacking community with level heads, to back the truck up and buy some more.
Because
so what are you going to go for? Where are you going to go for safety then if everything is going to get hit?
Cash is the only place to be in a crash.
Okay, so let's talk about your inflation outlook, because assuming that we are going to see inflation, wouldn't you just lose value to inflation then if you're holding cash?
Yeah, but a crash, I don't think this particular crash is going to be one spread over the next 6 months. It'll probably take a week, 10 days to roll out. You'll just see, as you normally see in crashes, the floor just opens and everything gets swallowed. It won't be a long-term thing. I mean, it depends what happens after that, of course. But I think it will just be a vertical, and if you're not there in equities when it happens, you get to keep your money. But if you're there, if you're in equities and it happens, well, you will take a serious haircut. And it's a short-term thing. It's almost a trade. I'm an investor. I don't like to do this. But, when you see and when you're, highly sure that you're going to get a crash, you have to go to cash and then wait for the moment where it either happens or you believe that storm has passed.
I mean, he's really making the case to switch your positions to cash. And so right now... I know 5 minutes ago I said I'm going to hold everything, and now I'm like, I don't know. We'll see.
What would be the trigger? What would trigger this crash?
Well, there's all sorts of potential triggers, aren't there? And I mean, you don't actually need a trigger. You just need something small to happen, and that causes a cascade. And then, of course, everyone will pull a reason out of their ear and say, oh, it was this, oh, it was that, oh, it was that. And it can be purely technical. A bank decides to shift its allocation, and that just triggers everything. Because sometimes crashes are like avalanches. It takes the smallest amount of a jog to set the whole thing coming down the mountain. And I think that's exactly where we are now. I think the pricing of so many of these stocks is so out of whack and sometimes so surreal. I mean, there's places in the UK, there's an airline whose share price is higher than it was last November. How can you have that situation in the current climate? It means the markets in many places are broken. Well, that's a very, very fragile place to be, particularly up to an incredibly contentious American election, particularly up with stimuluses going all over the place in many countries.
And that's kind of crazy. What the example that he just said, how there's an airline where the stock prices are higher than they were last year, really doesn't make any sense, being that profits are down across the board by and large for the airlines, right? Because we've seen the travel industry take a major wallop due to COVID. So that's kind of putting things into perspective there.
Okay, let me posit a counter argument to your inflation thesis. I know you think inflation's coming, but consider this. We've seen similar situations in 2008, particularly in the Eurozone, where we had very low interest rates, very low consumption following the financial crisis, following very low investment from the general public, and just very low aggregate demand in general. And so under this circumstance, isn't that just a definition of a liquidity trap, or we're going to see no inflation at all, Clem?
Well, the money's in the system, and to an extent it's trapped, okay? In QE, it got trapped in real estate and in equities. But this time, the stimulus has been at every single level. So there's been handouts to companies, handouts to individuals, people's getting job support, Really, it's unemployment benefit under another name. And basically, the money has been handed out in all directions. And the money supply has grown way more than it did under QE. In addition to that, it's not over yet. The problem of the COVID crisis and what that's done to the world economy, that's still ongoing. They're still digging a bigger hole. It's not repaired, and then we're going back into growth. The only thing we're going back into is a return to where it was before, and that's a long way off. And where it was before was a place where lots of countries had huge deficits anyway.
So again, what he's saying, basically, because of what COVID has done to the world economy, countries are still printing money to keep everything afloat, right? To keep Main Street and Wall Street afloat, companies and people alike. And because of this, and because of the nonstop printing of the money, you're having this devaluation, and it is just a disaster waiting to happen, right? It's just you're racking up all of this debt to help keep everything afloat, but we're just kind of kicking the can down the road.
So now we've got a massive deficit situation with governments that can't afford their budgets. An absolutely textbook example of what creates hyperinflation, let alone inflation, is when governments can't cover their budgets, they just print money. And we're seeing the beginnings of that, not the end.
Okay. But then, right. So let's suppose that you're right in that we haven't really seen the full extent of the economic repercussions from COVID yet. We're going to see more bankruptcies, more closures of small businesses. Wouldn't that have deflationary pressures instead then?
Well, what happens is the government won't say, oh, we're not funding the military anymore. Oh, we're not funding healthcare in Europe anymore. Oh, we're going to fire all our employees and cut back our budgets and try to get them back into balance. No, they just print the money. And that money will go out not into, like QE did, into the banking system to support it from going bust, to fill up their hole, their shortage of assets. And then it won't get trapped in real estate because they only lend it to people who want to buy houses. And it won't get trapped in equities because they will only lend it to people with collateral. No, it will go straight into the economy. It'll go into the hands of people that not only need to spend money, but want to spend money. Not a load of wealthy people that will just hoard it. So it's a different direction. It's a different mechanism. And that mechanism of filling your budget deficit by printing bonds that get monetized, which they will have to do because their budget deficits are just so gigantic all around the world. They will print money and they will pay it out to normal people. And that's exactly what causes inflation in places like Africa and South America. And there's no magic to creating inflation. If Venezuela can do it and Zimbabwe can do it, they could do it here, and they're going to have to do it.
So if you think that these repercussions from COVID would only play out fully in the medium term, why wouldn't you be defensive then? Why would you fully allocate to cash now before we see the full extent of COVID's economic fallout?
Well, I'm only in cash now because I believe it's going to crash in a matter of days or weeks, up to Christmas at the latest, maybe February the latest. If it hasn't happened by then, well, it's not going to happen.
Right.
And then I would get back into inflation hedges. The only reason to go to cash is if you think the market's going to crash, and that's where your money is tied up. If you didn't think it was going to crash, you'd leave it there. I mean, after all, there's been a stock market miracle. I just think that miracle is too good to last. And I just think that the disruption that's going to be in America up to the election is going to be so bad or so disruption-ish that it's going to break the dream, and we're going to get a bit of a comeuppance. Because I'm sorry, I meet a lot of people that are kind of stunned, in shock, in a kind of weird state of mind. And the markets are the same way around. You can't look at the economy, you can't look at the fundamentals of the world and say it isn't a very, very, very scary picture. And it's just not reflected in the stock market. And the only way that prices can be so high is if people are trying to hedge themselves from inflation. Well, I don't think that's a bad thing to do. But in the very short term, I think we're going to get a very big stock market correction. And being in equities is a very dangerous place in the short term.
Robert, Clem, there must be another crash later on then, right? If you're expecting bankruptcies and whatnot to happen.
It's a strong possibility. It's a very, very strong possibility.
Almost like a double whammy. That they're expecting this crash. Well, this guy Clem, whatever his face is, he's expecting a crash right now in the stock market. And due to quantitative easing and the nonstop printing and everything, and all these companies going bust, that there's going to be major bankruptcy issues. So there's going to probably be a second hit. Uh, we'll see.
And if they keep stimulating, and if they decide that it's better to print money than to cut back on social budgets and programs and projects, well, the only outcome potentially is inflation. They can't just print money out of nowhere without the money coming from taxation. It's just, unless they've reinvented economics.
I'm sorry, I just got to say also, he looks like he just rolled out of bed. I mean, come on, you're on KITCO, you got to comb your hair at least.
In the last few months, if you print money and you don't have production and you don't have businesses to give you the supply for the demand, you're going to get inflation. And the potential long-term economic disruption and downdraft from this is almost incalculable. And I'm reserving my judgment for that. We could have a terrible economic situation and high inflation, just like they had in Hungary in the 50s, just like they had in Germany in the 20s, just like they've got in Africa in places now, just as they've got in Argentina and Venezuela. And, that is certainly a possibility, but you'd be a brave man to say that your crystal balls are so shiny that you can see more than a few months out in this situation.
Yeah.
But there's a high likelihood of a crash up to Christmas, and there's a very strong likelihood of inflation over the next 3 or 4 years. And you have to be able to navigate between those poles cheaply, quickly, and be able to, get out before everyone else runs for the exits.
Clem, don't you think we could possibly see a scenario similar to that of Japan in the 90s, when we have a lot of accommodative monetary policy, large money supply, but people are holding off their big ticket purchases because they expect prices to go down the following year, savings rate become high as a result, and that becomes a self-fulfilling prophecy, right? That pushes prices down. Could that happen in North America and Europe?
Yes, it's possible, but the American government doesn't lend money just to Americans like the Japanese do. So the Japanese can have this vast national debt, which is basically owed to its own people. America's not in such a great situation. It's got its borrowings internationally, and if they don't actually monetize them, or they don't sell the debt abroad, it has to, there's no one else to sell it to. They have to turn into dollar bills. And if the production's not there, and if the demand's not there, but there's all this money spilling out everywhere, well, it's going to cause inflation. That's how inflation is caused. It's caused by more money than supply. And this is a different mechanism than QE, because QE was filling up a hole in the banking system of assets and was going into real estate. And you did get inflation, really, if you want to think of it that way. The inflation was in property. I mean, the prices of properties rocketed, and rents, et cetera. Everyone can see how much those prices have moved in real terms. And that's because that's where the money went. Well, this time, it's not going to go there. It's going to go into the general population. It's going to go into the general economy. It's not going to get locked up in the banking system. And therefore, it's going to go on all the other things that people need. And, that is the reality of having a supply of money without supply of goods. I mean, if the economy is not producing, if you increase the amount of money, it's going to push up prices. If you look at Japan, which is interesting, their exports are down 10%. Their imports are down 10%. Their overall level of activity is down 10%. And if that is representative of the world, well, if you increase the money supply by X% and you decrease the activity by Y%, you are going to get increases of prices.
Okay. Well, let's say I don't want to be in all cash. Let's say I do want to be invested somewhere. There must be a few stocks that you like that you think can weather the storm. Would there be?
Okay, so he's not really too, I would say, thrilled. Is thrilled even the word? He's not too. He's not giving us a lot of reassurance that any stocks are going to come out unscathed with a current stock market pending crash.
It's a very, very, very tricky game to be long in a bear, and it's an even tougher game to be long in a crash. And
at least he's not like saying that he thinks these different companies are going to do well, and he's not answering because he knows that he's not going to be able to call it.
No, is the short answer.
Okay. What about crypto and gold? What role do they play?
Well, I mean, if you look at the last crash, the crash in March or whenever it was, crypto and gold slumped but bounced really fast. And that is, I've actually held on to quite a lot of my crypto, in fact the bulk of it, because I think potentially it will crash, but it would bounce really hard. So,
I don't have any crypto, and again, that's an awesome shot that I paused him on.
So, I don't really want to be able to time that. Gold would probably do something similar. It would crash because of people having to liquidate to make up margin calls. But then again, it will bounce pretty quick and probably be pretty strong thereafter. But, the equities will definitely drop really fast. And I think crypto is quite interesting because I think there's potentially trouble brewing in China. And, crypto will be the signal for trouble in China. And so therefore, I want to have a good bet on crypto, because I think there's a possibility that there might be some pressure in the government in China, and that will go straight into the value of crypto. But that's a long shot kind of thing. One of the things that I think about is that I don't think anybody in power when COVID struck will be in power the next time they go up for election. And so there's going to be a huge political upheaval, and crypto and gold also would be pretty good for that. But in the short term,
that's actually a really interesting point, right? So President Trump right now in power, they're saying that basically anybody that's in power when COVID hit, that he's thinking because of the way COVID probably was handled by a lot of different nations, possibly people are gonna want to change and take it out on whoever the current serving leader is, and elect somebody new into office. That's actually an interesting take.
This potential crash will take everything down with it, because that's what crashes do.
No bonds, right? You're not holding on to bonds.
I'm not a bond person. I'm so not a bond person. I don't feel even qualified to talk about bonds. When I was a young person reading about finance and investing, it seemed to be a litany of governments reneging on their bonds since the beginning of time. So I thought, if King George III will do it, and Charles II did it, and Charles I did it, and Edward III did it, maybe now won't be so different.
All right, fair enough. Clem Chambers, thank you so much for coming on the show today with your thoughts. I appreciate it.
All right. Well, there you have it, everybody. Move into cash seems to be what he is saying. And like I said, I had that other interview not too long ago with Chris Vermeulen, and he was also saying that there is going to be a gold and silver pullback. So you might want to hold on to your cash right now for the next 3 to 6 months and kind of wait for this opportunity to arise. And maybe you want to talk to your financial advisor and consider repositioning yourself within the stock market. I'm kind of on the fence myself. I might just leave everything there and then wait for this bottom to present itself and buy some more. But we'll see. And I just want to quickly thank these elite channel supporters. And if you haven't become a channel member, please check out the awesome perks and join today. With that, I'm the Stacking Stormtrooper. Check out these videos. Until next time, long live the Empire.